Really am delighted to be here with you today. And again, as we have a few more people coming in, if there's an empty seat beside you, maybe if you can scoot in, make it easier for those coming in a few more minutes. And it is a full room. I don't know if we need to have the air turned down already, but as I get fired up, it will get hotter in here. So, okay. As we get started, I'd like to just maybe ask a couple questions, show of hands. I want to make sure I'm addressing the topics appropriately for this age, not this age group. I'm the old man in the group, but for your knowledge and experience level. So how many have any experience in accounting generally? Okay, and I'm talking about more than just balancing the checkbook. For those of you that are my age, know what a checkbook is, what it means to balance that. Okay, how many have not-for-profit accounting experience? Okay, great. Let's think a little bit about size and complexity of organizations. How many of you have a budget, let's say, of less than $250,000 a year? Okay. How many have a budget, annual operating budget between $250,000, let's say $750,000 or $1 million? How many have an operating budget greater than $1 million? Okay, so we got a great bell curve of all the different sizes, complexities, and so I'll try to address all those questions. I will say that normally when I do these presentations, I really enjoy and encourage you to ask your questions while I'm talking and interrupt me. However, because we have a lot of people online who are also watching, it would be very, very disruptive to make that happen. So take your phones out, make your notes or a little piece of paper and make note of what your question is so you don't forget it. And then I'll do my best to save time at the end for questions, if that makes sense. Okay, any questions before we get started from those here present? Okay, so let's see if I can make this thing work properly. You know, these are the disclaimers that legal folks and QC folks always have us do, that I'm not giving you any specific legal accounting advice or investment advice. This is an educational session, okay? So now you don't have to read the fine print, and I don't have to go through and read it either. We have really about four main topics I want to just high-level cover today for you. And I'll be honest with you, I don't want to scare you, but this is normally about 6 or 8 hours worth of content. I have about 40 minutes. Now, the good news is I'm going to be really brave and see if I can go all the way to the end and let you know that, because I knew I couldn't get it all done. Back one. If you'll scan this QR code, and it will be there at the end again, there are a lot of resources there that we made available for you to take home, and they are yours to use, keep, and or throw away. That delete button on your cell phone or your laptop work really, really well. But there's a lot of policies that I will reference that you may or may not have, but you should have. And rather than having to recreate the wheel, just take this and make it your own and customize it. Now let's see if I can get all the way back to the beginning. And that concludes our session today. Okay. Okay, so we're going to start talking a little bit about finances. And again, most people at this point, let me just highlight it really quick. Financial best practices within the not-for-profit world are different than the for-profit world. Again, we're talking about a double bottom line that has impact more than just profit. So I think Jeff Henderson's probably already talked a little bit about that as well this morning. So again, those of us in the not-for-profit world and certainly within the accounting world, we got to come up with unique things that are totally different than everybody else that make it complicated for everybody. I apologize. That wasn't our intent, but so be it. So in the not-for-profit world, we have what we call the Statement of Financial Position. So that's a technical term, which is very similar to a for-profit balance sheet. Okay? Now, I'm just going to cover these quickly. All these terms and their definitions are in that QR code flip book that we created for you. Statement of activities is the not-for-profit income statement. Statement of cash flows is the same, but then what's really important would be your budget to actual financial statements. And then for the not-for-profit world, and certainly for your 990 tax return, IRS tax return, the statement of functional expenses is a very, very important allocation of your expenses that will then tell you how much you're spending on your programming, how much you're spending on general administrative, and how much you spend on your fundraising. Within that, your financial statements, very similar to the for-profit financial statement, your financial position is going to have your assets, liabilities, and then instead of having your equity or ownership line item or category, it's the net assets. So again, similar to the for-profit side, your assets will equal the combination of your liabilities and your net assets. What makes it interesting, though, is your net assets, which would be kind of, if you think about it in a personal financial statement, your net worth, what's your company worth, what are you personally worth, everything you own, including your home, minus what you owe, the mortgage on your home, your car loan, et cetera, that ends up being your net worth. That's kind of what net assets are. However, in the not-for-profit space, net assets are broken into two categories. And so if you're like me, we grew up with, hey, I can't be out of money, I still have checks. That's not the way this is, okay? So we ask the question in the not-for-profit world, it's not how much cash do we have, it's whose cash is it? Okay? And that's where this comes in. I want to spend a little extra time here because as a not-for-profit, what we find, and our firm has been around for 50 plus years, we are the largest firm in the world that only works with not-for-profits. So we're a national firm. We have offices in 15 cities, major cities across the U.S., coast to coast, border to border. And we work in about 200 countries. But again, we only work in the not-for-profit world. And so what we find is a lot of organizations will fail either because of poor leadership and because of finances and not keeping track of their finances accordingly. So that's why it's a very important thing to just at least bring to your attention and make sure you're spending time with your accountant to work through these areas specifically for your organization. The most common asset that we think about in the net assets and or even in your cash balance would be your assets without donor restrictions. These would be contributions that come into your organization that have no restriction. They're just giving it to the organization to accomplish your mission. Now, if you're getting grants, a lot of times those grants will come with a restriction, specifically for a program that you applied for and you'll need to report on. And then within the grant world, there are those that you have to spend your own money for, and then you get reimbursed from the grant. Others, they give you the grant dollars up front. Then you have to report on it before you get the next installment. So make sure you're keeping track of that. And that would be the assets with donor restrictions or grant restrictions. Now, what we find on a regular basis is that management and boards and not-for-profit leaders confuse and or think that a restriction and a designation are synonymous. You would think that, hey, it's restricted or it's designated means the same thing. Not in the accounting world. So only donors and or grantors can restrict contributions or grant dollars. However, management and the board can designate funds. So for example, a lot of boards will have a policy, and we'll talk about this in just a minute, where we're going to set aside X percent of our budget every year, 2%, 5%, 10% of our budget, to create a reserve account. That money can't be spent by management without board approval, but it is unrestricted, and so on your financial statements, it should show up as assets without donor restrictions, but then there can be a separate line item underneath that would say, this amount has been designated by the board/management. Okay, let's move on to the next slide. We've talked about this already, but let's be a little bit more specific. Donors are the only ones who can restrict donations, and it's usually restricted for time, purpose, and again, the board should set these up in advance. Okay? So for example, if there's a new program that you want to initiate at your not-for-profit, you want to make sure you've approved that with the board, that management has it set up, and then you start requesting those dollars. And then they go into those funds, and they're restricted. And again, it might be that we're going to restrict these for a capital campaign. We're going to build a new building. It's for a new vehicle. It's for a new community outreach, a new location. So that would be the purpose. Or sometimes some grants or some donations will come in and say, hey, we're going to give you $1 million, for example, but you can't spend it in year 1. You can only spend it in year 2 and 3 or beyond. Board management designates the funds, but you can't restrict them. So again, restrictions can only come from donors. Let's talk a little bit about budgeting, and this is where organizations get in trouble. Just because you budget to break even, or maybe even have a small surplus, does not mean that you will be able to make it work financially. Okay, so let me use a couple of terms for fun that might make it a little bit more practical. And so let me think about it this way. How many of you have an organization that would be an agrarian organization versus a manufacturing organization? And let me explain that. An agrarian organization, if you think about that term, will have 1 or 2 harvests a year. Okay, which means you have a lot of extra money coming in once or twice a year. Anybody want to guess what month of the year most organizations get the most money? It's because it's Christmas. Everybody wants to be generous there, right? Yeah, maybe. It's actually because it's a great tax incentive before year end, right? So there's no reason why you couldn't be generous any other month of the year. But we tend to do it in December when bonuses are paid. We're trying to get our taxes done in advance, and that's when a lot of this happens. But some organizations, I'm thinking of private schools, they may have a big influx of dollars at the beginning of the school year when some families pay in advance. Some may do it twice a year at the beginning of each semester, and other families will do it on a monthly basis for 10 months. So that would be more of an illustration of a manufacturing organization. I'm going to suggest possibly like a Chamber of Commerce that has membership, and every month there are certain members' dues, and their annual membership is due on a certain month. So that would give you an even flow of income throughout the year, and then you can actually then budget accordingly. Now, what do you do? And a lot of not-for-profits, and I'm going to throw in churches in this. When's the toughest season, months of the year? Summer months. Why? Everybody's on vacation, everybody's distracted, even schools, their tuition dollars are paid usually up through May's the last payment, then they're off a few months, and then they start again in August. So summer months are the worst months. So that's when we're going to suggest that you think about setting up a budget to monitor your cash flow on when are your big events, when do you have the big cash requirements, and do you have enough money to fund those, not just because you have enough money all year, but do we have the money to pay when these activities take place? And sometimes you'll want to then adjust the programming to also match when the money comes in. Now, certainly budgeting is a big deal, so let me go a little bit deeper on that. There's a lot of ways to do budgeting. I don't have time to go through the 6 or 8 methodologies. I'm just going to cut to the chase and give you a suggestion that maybe a best practice that we see as one of the most effective ways to budget for an organization is really what we call a hybrid, where top management and the board set the budget, and then you allow the budget managers to decide how they're going to spend it within the line items. Why is this? Well, if you let everybody decide how much they want and you tell them to be creative, what happens? One particular department becomes very creative, and ultimately they create a budget that is more than the entire organization has. And then they've spent a lot of time and energy. You got to go back to them and say, this isn't going to work, and now they're really discouraged and disappointed because you told them to be creative and dream big, and they did, and now you shut them down. So we highly recommend, if this is what the total budget is for the year, let's make it really simple. It's $1 million, and we know that X amount is going to be what we call overhead or fixed costs. It's going to be insurances and the audit fees and taxes and rents and utilities that nobody really gets to control a lot. But then then we come back and say, okay, this department gets $100,000. You tell us how you're going to spend $100,000 to accomplish the goal that we're giving you to do. So you've got this outcome, and this is how much money you have. Go. Now they're a lot more focused. If I have to have this outcome, how do I best utilize the money to get there? Now everybody's on the same page. We're not competing for the same dollars, and we can get it done much quicker. And then there's ownership by each group that says, yes, we came up with this plan to accomplish this activity to get these results, and they're responsible for it, versus somebody just saying, you have to do this, and here's how much money you have, and they can't control that input. And I'm finding I'm having a hard time not saying, does that make sense? Any questions? But I will hold off on those because I know Annie in the back is taking those. I mentioned how important budgeting is. It's because cash flow is really, really a problem. And a lot of people will run out of cash in the summer before their big donation month in December arrives. And that creates problems. So what's the best way to overcome this? Well, certainly we recommend that you should have at least 30 days reserve and then move towards the 60, 90 days, the more volatility you have in your income. Okay, so really quick, just a little bit about myself. I was actually born and raised overseas. My grandfather was a college president, resigned and moved the family to Guatemala. And they became church planters back in 1947. So my dad was raised there. Consequently, my two brothers and I were born and raised in Guatemala. So I grew up speaking Spanish, learned English in school, and moved to America for high school and college, thinking I was going to go back. My undergraduate studies were religious studies, as well as aviation. And I ended up moving to Alaska as a missionary pilot. Lived in North Pole for 7 years and Kodiak Island for 6. So, and then I ended up getting my MBA there. And so my major as an MBA was cold cash and frozen assets. Just kidding. But I ended up going to work for State of Alaska Fish and Game, doing their accounting. Then moved to Kodiak Island, where I worked at a residential group home facility, working with at-risk youth with a 2-year program, as well as an emergency placement. And so I've been in fundraising for about 35 years, and I've also been doing accounting for about 35 years. So I have a split personality. I go out and raise the money, come back home and count it. But then I actually worked at a CPA firm, headed up the not-for-profit practice, got recruited to go to work for a law firm. And the firm I was managing with offices in Seattle, Anchorage, and Kodiak was one of the firms that tried the Exxon Valdez case back in the day. Our oldest son is 36 years old, experiences multiple disabilities, requires care 24/7. And that's what brought us to Atlanta. He needed a surgery that we couldn't get in Alaska and we couldn't return. So we moved to Atlanta in 2000, and I've had the opportunity to work with a lot of great organizations here in the Atlanta area since 2000. I've been working with Chick-fil-A and WinShape for about 12, 14 years now, and really enjoy the opportunity to work with organizations like you here today. But again, as part of this whole thing, we want to make sure that you're understanding the risks. And so let me just, again, what I find is when you think organizationally, sometimes it's a harder concept to grasp. So let me see if I can make it really personal. Anybody know who the name Dave Ramsey? Yeah, you guys are my crowd. Okay, so Dave Ramsey, what does he say is the first baby step to take to get out of debt and to get $1,000? Where does that $1,000 come from?
It's how much you need. Like if you have insurance, it's kind of like what's your deductible.
But why $1,000? Why not $500? Why not $5,000? Simple question, and that's what ties back into this. People ask me all the time, well, how much reserve should we have as a not-for-profit? Well, at a minimum, I'm going to say you need at least 3 months, but how do you get there? And then beyond that, we can get more specific. So let me cover that really quick in a few minutes also. The $1,000 first step cash reserve that Dave Ramsey recommends is really simple. The average household income in America is what? $50,000. Divide by 52, and we're right at $1,000 a week. What Dave Ramsey's saying is you need at least 1 week of operating reserves as an emergency fund. How far does a week of operating reserves last if you get laid off? About a week. That was a trick question, but I'm sorry about that, but it's 1 week of reserves gives you 1 week of options. Is that enough? So what kind of options do you need? It depends, exactly. So let me go back to some of my history. When I lived in Alaska, if you were in construction, and we had a lot of winter months and a lot of darkness in Alaska, we experienced 74 degrees below zero. If you're in construction, how much reserves do you need in business? A lot. Why? Because our building season in the summer was 2 days. Okay, maybe a little bit longer than that, but you get the idea. However, if you're in Atlanta and you have two professional incomes, an attorney and a doctor, how much operating reserves do you need? Well, it's a fairly stable market here, and you're in two professions that make a lot of money, and they're fairly stable. You'll automatically create reserves, and you're not having to worry about those, volatility of income. If you're a salesperson and you're on commissions, you better save up more. I'm thinking real estate. Anybody in real estate? Yeah, that's a tough time to be in real estate right now, right? So you want to think about it in those terms. That comes back to that agrarian time frame. So at a minimum, as an organization, you want to at least start with 1 week. So what's your total operating expenses for the year? Divide by 52. Now, as a profession, we measure it in days, operating days, because then we take your total budget, divide by 365, and that's how many days of operating reserves you have, because that's the most conservative and the most effective way for not-for-profits to measure cash reserves. Now, again, if you're an organization that has big swings in your income and big drops in your income, then you want to think about what's the gap between the big harvest and my deficits on several months before I get to the next surplus. And that becomes your operating reserves for your organization specifically. Does that make sense? Okay, and if you guys have questions, I hope you're writing them down. If you're online, that you're sending those chats in and we'll chat them up, vote them up, and keep going. Now, here's the other challenge we see a lot of times where organizations get themselves in trouble. We have cash, we have money to spend, but the cash isn't theirs to spend, it's already restricted, and you end up with a negative amount that you owe more than you have cash for, and you have a liquidity problem. If you had to pay all your bills, you wouldn't have enough money. And so then what happens to organizations at that point? You go wonder, and in the process of getting there, you start delaying payments to your vendors first, and then you start missing payroll, and by then you're totally out of options and it's hard to recover. So that's why we want to make sure everybody's starting with at least 1 week of reserves, building towards 30 days, 60 and 90 days, or if you want to get more sophisticated, look at your own operating budget of how much cash you need every month, and then when does the money come in to match that. There's another little bit of a misconception around general administrative expenses and fundraising expenses. And there's been a real myth for decades that organizations that spend more than 10 or 15% on G&A and fundraising are not efficient. There's been a lot of research that we've done as a firm and others to say that if you are not investing in your general and administrative costs and your fundraising, you are not sustainable long term. And so that is now coming out. And so I'm a strong advocate. I teach this nationally, that as an organization, I would not be afraid to go and spend up to somewhere between 20 and 25% of your budget on general administrative and fundraising. Now, do not be sloppy and do not be careless with this. It needs to be intentional and strategic. We would say you want to think about your infrastructure, in particular your technology. One of the things our firm does is we work with a lot of not-for-profits these days where we're working with them to move from what we call non-value labor costs, especially in the business office, doing tasks that a computer can do much faster, better, cheaper, consistently, and then that allows you to take those staff dollars to do more program activity. But it does take an investment up front to get that done, but you can normally recoup that in a year. The second thing is within fundraising. A lot of fundraising folks are concerned that we're spending too much money on fundraising. And fundraising is an investment for the future. And if you're doing it well and you've got the right folks, and I'm delighted that there's other workshops here around fundraising, you need to make sure you're participating in those or getting the recording after the fact. But the reality is, think about it from a for-profit side. If you want to grow a new market, what do you have to do? You do marketing. A new product line, what do? You spend a lot of money on marketing to get the word out about a new product or a new geography, new territory, before you see the sales come in behind you. What are you doing? You're going out and buying names. You're doing all kinds of ad campaigns. And then that's what fuels the sales, which are delayed X amount of cycles. The not-for-profit space has to do the same thing. You've got to invest in some new name acquisition, some strategies. You've got to keep testing them to make sure they're effective, but don't hesitate to spend some money in fundraising to help your organization grow, because if you're not growing, by definition, you are contracting, okay? So I want to make sure I highlighted that. The other thing I highly suggest for organizations in their budgeting process is budget about 90% of last year's revenue for the new year, fiscal year. Why? Well, you want some margin. Number one, if you budget 10% of last year's income, that will say automatically you're built in 10% savings for reserves for ongoing growth. The bigger you get, the more reserves you have to have. If you're a $500,000 organization and you want to have, well, let's call it $480,000 organization, and you want to have 1 month of operating reserves, you need to have $40,000. But as soon as you become a $960 million organization, you need to double that for 1 month. So every year you need to be adding to your reserves as your organization is growing, so you maintain the liquidity and the runway that you need. Moving on, let's talk a little bit about transparency best practices. This is a really important topic for your donors. It's a great marketing opportunity, and it really will affect your grants, your ability to receive grants. So let's talk about that really quick. Number one, the IRS has your tax forms, and it's actually what we call a series. It's the 990 series. So if your organization has less than $25,000 a year, you're still required to file a 990, and that would be the 990N, or we also call it the postcard. It's a super simple. And again, I'm sorry, I said 25, it's $50,000. The 990EZ is between $50,000 and $250,000 of revenue. Once you get above the $250,000, you have to do the full Form 990. That's a very important IRS form, and it's technically called an information tax return or an informational financial return, because there is no tax implication, but you still have to report all of this information. This is one of the best opportunities to broadcast and market your organization, and a lot of people miss it. There are, on pages 1, 2, 3, and 4, there are places where you talk about what your mission is, what your purpose is, what your outcomes are, and it's a great place to get free advertising. Not just so that the IRS gets to read it, maybe they'll start donating to you. Okay, maybe not, okay, but we can always hope. But the reality is a lot of your donors will go online and read this. It will also affect your ratings from like GuideStar, Charity Navigator, et cetera. So make sure you're paying attention to these. From this, there are some great ways to get bonus points, if you will. A lot of organizations are checking the IRS tax form, Section B, questions 10 through 16, okay? And this is where we'll start getting into some more information. That's on that flip book that we provided for you. Here you'll see number 11. Number 10 is just really informational. It may or may not affect a lot of things, because that's okay to say yes or no. But on 11, have you completed the 990, and do all members of the governing board see it and approve it, or at least get to see it before you file it? That's the best practice. Make sure when your 990 is completed that you have the board all see it and hopefully approve it before you file it. A lot of organizations will just file it and then show it to the board after the fact. The reality is your board members have a fiduciary fiscal responsibility, and if it's wrong, they're the ones held liable. The IRS wants to know, do your board members know? Have they seen it? Do they agree with it? So that's a great way to get extra points, if you will, on all these scoring is, do you have this policy, and are you following this practice? Number 12, do you have a conflict of interest policy, and is it being monitored? So great information. You need to do this. And again, we have all these in that flip book that you can, if you don't have a conflict of interest policy, you can certainly get one there. Do you have a whistleblower policy? Really important, certainly in today's environment. If you don't have one, we've got some samples there in the back. Document retention and destruction policy. Very important. You either have it or you don't. It's a right or wrong, yes, no, and having a yes is a simple way to pick up some extra points, if you will. Determining the compensation of, in particular, your CEO and or others who have a significant influence and control over the finances and the direction of the organization. So we would call it the CEO and the C-suite. You can call it the director, the VPs. And again, it's what the IRS calls the rebuttable presumption of reasonableness guidelines. And so, as a matter of fact, Kelsey's in the back. She's on my team with Capin Crouse, and she is both a certified human resource manager. She's also a compensation professional. So she does all of our compensation studies as a firm nationally for all of our not-for-profits that engage us. But that's a really important thing to make sure that the compensation of your CEO or yourself is being monitored and approved by an independent board. So keep that in mind because that's a really, really big deal. Okay, moving on. Again, these are some of the ones you want to make sure you have, and we've got samples of this in that flip book for you, including the accountable expense reimbursement plan. Really quick, covering that in just a couple minutes. I know I'm doing a fire hydrant drill, but I've got to be done in a few minutes, so I want to make sure I'm at least creating awareness, and then you guys can follow up with all this information that you can take home. But the accountable expense reimbursement plan is actually a document, a policy that you need to adopt, and that's what allows those reimbursements of ministry, church, or not-for-profit expenses to be reimbursed and it not be taxable. Now, there's a few more things as part of that policy a lot of people miss. The IRS expects that expenses are reimbursed, or I should start by, are submitted and reimbursed within 30 days. There's a little bit of wiggle room for 60 days, potentially, if there's justification for it. But beyond that, technically it becomes taxable income to the employee who is submitting for reimbursement according to IRS rules. So we've had a lot of clients, a lot of organizations where, in particular, the executive director, the CEO, the president, is really, really busy. He's always traveling. He doesn't have time to do his expense report, and 6 months later, he wants to get caught up, and it's a large amount. The organization is having a hard time budgeting for it because they didn't expect it, and technically that does become taxable income. So think about that. Again, the policies are in that flip book for you. Separation of duties is another really important, which is a kind of a segue to the next topic around fraud and fraud prevention. Every organization needs to make sure you're separating the duties within the business office and specifically the accounting world. You do not want the same person who's processing your contributions to make the deposits and recording them in your accounting system. Why? Because you can dip your hand in and cover up the tracks and nobody will know. You don't want the same person opening the mail, processing your accounts payable, writing the checks, signing the checks, balancing the bank account, and entering the information in your general ledger accounting system. Why? Same issue. There's a lot more details around all these things, but certainly most organizations don't have a lot of extra money to hire a lot of extra accountants. You don't have to be an accountant to do a lot of these things, so there is a really great chart that you can say, hey, we're a small enough office, there's really only 2 people available, including a volunteer or somebody who knows nothing about accounting, but here's what we can get them to do, here's what we can get a board member to do, or a 3-person business office or a 4-person business office. All that information in the charts and who needs to do what are in that flip book for you. Another major deal that we see a lot of challenges with not-for-profits are the improper classification of employees versus independent contractors. And so I don't have time to go into all the details, but there's certainly the IRS criteria that we call the 20-factor rule. That's available as well for you. And within that, you want to make sure that employees are really employees versus, or more specifically, the independent contractors aren't really employees, because here's what counts. And I don't have all the charts for today, but it's a really big deal because the government is short on a lot of income. And what happens is employees, because those payroll taxes are mandatory, and they go through a fiduciary trust system where they're automatically taken from all of our payroll, automatically deposited in with the IRS, they get paid. 80% of payroll taxes that don't get paid are through independent contractors. Business owners, athletes, entertainers, and about 80% of them are struggling to make the payments because, let's face it, let's say you're an athlete and you win the Super Bowl or you win some big event and you've got a $3 million bonus, and it's a lot of fun to spend it. But then when you got to pay $1 million, $1.5 million of it in taxes, well, I just bought mom a house. I don't want her to get evicted. So you just don't pay the taxes, right? So that becomes a real problem. Make sure you're paying attention to that. And generally speaking, for most not-for-profits, the simple rule is they're most likely an employee, even if they're part-time and occasional. So let me think about, if you have any kind of a daycare program, for example, that's always a classic example. You've got to have a lot of background checks. And so, hey, you hired my son or my daughter to work in your daycare. She can't just arbitrarily say, I'm not coming, I'm sending my friend in. But if I'm in an HVAC system, you don't care who shows up, just fix the AC before we melt. Okay. Board reports, really important because this is part of the accountability. I'm assuming most of us in here are on the management leadership side. We've got a board that we report to. What should they receive? Again, at the top, we've already covered this. Make sure that they're seeing the 990 before it files and that they're at least a verbal, an email approval. Yes, we approve the 990. Throughout the year, I'm going to suggest at a minimum quarterly, you should do a quarterly review. Some organizations want to have a monthly review. My recommendation as a best practice, if you're a smaller, younger organization, you need more oversight. Again, I like to use family illustrations, personal illustrations. Toddlers need a lot more supervision than elementary age. And then it becomes teenagers, then they need a lot more supervision again. They're just a lot more resistive to it. And then they graduate to become fully functioning, productive citizens in society. And then you can kind of dial it back and check in less frequently. So don't be defensive if your board wants more engagement. It's actually a good sign. And once you establish trust and everything is going well, then it might revert back to that quarterly basis. But when things are in trouble or things aren't going to plan, engage them and have them come in and join you in those conversations and help you solve it. Because ultimately, they're on the hook with that fiduciary governance responsibility. But you want them to see, again, these financial statements, the statement of financial position, the balance sheet, the income statement, budget to actual. And certainly, it's always important to tie the program results to the financial statements. Again, this is not just a business. We're trying to say this is what we're at financially, but this is what we've been able to accomplish because that's why board members are there to hear the results of the impact that you're having in your community. System best practices as we move on. Make sure you have the right accounting software, staffing capabilities, look for gaps and options. Sometimes a lot of organizations really need to outsource. So if you're a rapidly growing organization, you might need the sophistication of a CPA as a CFO, as a controller, as a director of finance, but you can't afford that level all the time. You might want to just outsource a few hours a week or a month to have that level of expertise while you have a bookkeeper doing the work otherwise. Somebody can help you strategically think through that. Again, in this flip book is a description of the difference between a CFO and a controller. And again, a lot of organizations use those terms synonymously. We also include the term director of finance, and so all three of those have a different profile, temperament, and expertise. So think about what you need in your organization, and then try to align the title with the right skill set, right experience for what your organization needs in its corporate life cycle. Sometimes you just need to hire specialized staff, and it's hard to find that unicorn otherwise. One of the large international organizations I used to lead, we needed, within our IT group, we needed someone who was a network administrator, but we also needed a systems engineer. And I only had the money for one person, and finding somebody who could do all those technology issues doesn't exist at our level. I ended up outsourcing it and got the best in class of 3 different specific skills that I needed, and they were only having to do what was their area, and because they were outsourced, they had peer comparisons and they had best practices from other organizations they were using, lowered my cost, increased our capabilities for the same amount of dollars. So I want to encourage you to think about that in that realm. For most organizations, I want to suggest certainly if you're less than $500,000, possibly if you're $1 million or less, QuickBooks is probably as good a solution as any. And there are a lot of automation tech stacks you can add to that to really make this seamless and reduce the amount of, again, what we call the non-value labor costs. And it reduces the risk of fraud and cyber fraud within your systems. Now, I know most of us think about, oh, the more online I am, the more risk of fraud there is. Not necessarily. Sometimes we see a lot of fraud through the human interaction where there's not enough proper controls. Within cybersecurity, again, be very, very careful. Highlight really quick, we're seeing a significant increase in cybersecurity risks and fraud. We actually have an entire division at our firm dedicated to cybersecurity issues and helping organizations deal with those. And so, again, a lot more information available online at our website on these items, but make sure you want to pay attention to that. Fraud risk, we talked about that, certainly cybersecurity. We've had more incidents in the last year of our clients dealing with fraud where someone penetrates through the email system and impersonates a key leader, and then suddenly that key leader is requesting dollars from the accounting department, and if the accounting department isn't sophisticated, hasn't been trained properly, they end up doing the wire transfer, and because the organization had initiated it through an employee and it's all properly authorized from the organization, the banks can't return the dollars because it's not their fault. So think about the training. Again, about 60% of organizations do not do any kind of fraud prevention, and that's why they have some of the highest levels of fraud risk. There's a lot more information available on our website on how to prevent fraud. And a lot of times we think that it's going to cost a lot of money. It does not. So we've got a lot of articles on our website around that topic. I don't have time to go deep on it, but I want to make sure you're aware because that is a growing issue that we're seeing. As a matter of fact, we've just launched a new initiative this year around fraud prevention and forensics. Board governance, really important topic for us here today to think through what does that look like. I just want to think about research indicates and tells us that the optimal, best functioning boards are 7 to 9. 7 to 9 is the range. Now, I will acknowledge that there are certain boards that are large, and many times they're a hospital or university board, and they may have 20, 30, 40, 50 people on them, and those are what we would call political or influence appointments. And if you'll study those boards, they will have an executive committee of 7 to 9 who are actually running the organization, okay? So most organizations think we need a lot more board members than we need. Less than 7, it's hard to always have the functions that you need and the quorum. Above 9, it becomes harder to manage. So here's just some suggestions. Again, all this information is available to you in the registration packet and online. But we suggest creating some profiles of some of the demographics, race, age, professions, the different skill sets based on your organization, what you might want. Let me focus again really quick on the Finance Audit Committee. We see a lot of issues here where if your Finance Audit Committee to be highly effective needs to be probably 3 to 7 on that committee. You absolutely should have an accountant, CPA, and in particular someone that has not-for-profit experience, knows what they're looking for. You probably want an attorney on that board, maybe a banker, a financial manager, otherwise an entrepreneur to serve on that committee. Small project committees, so you might have an organization and there's a particular project you're working on. Again, here's just a variety. You might want an accountant who can help manage the budget for that particular project. Community professional, and a lot of times what we see is, and certainly in the not-for-profit space here in Atlanta in particular, there's a great opportunity to get corporate people on your board, government officials, school districts, first responders, all these different groups based on what you're doing who can help influence what you need. So especially I'm thinking of those who are dealing with adolescents and or food insecurities, et cetera. Having somebody from the school district or first responders can tell you where some of the greatest needs in the community are and how you can reach those because they're dealing with it every day. And too many times I work with organizations who have great ideas and they implement them without doing research or getting community engagement. So one of the best outcomes, best practices from a finance and outcome perspective is make sure you have a good diversity on your board. If you have a larger committee, you want to add some additional people to it. If you have a large project, certainly you increase that. Now, you'll notice I said the ideal board is 7 to 9, and here I've got a large committee of 7 to 9. I wanted to highlight that in particular because a lot of times you can have committee members that serve that aren't board members, and that becomes a great farm team to bring people in and start training them, getting them aware of the organization around their passions. And then if they're really engaged, now you've started pre-training them to become a board member. Now they become solid candidates because you have a lot more experience. I will give the one caveat now, without going back to that slide. The Finance Committee in particular, in some states, and Georgia in particular, you can only have board members on that committee. You cannot have non-board members on a finance/audit committee because of the fiduciary finance governance requirements. Now, the way you get around that, and I actually get to do this on some organizations, you can have guests on that committee. They just don't have a vote. So at that point, a lot of organizations, smaller ones, they need a CPA on their finance committee, but they're not on the board. So they will bring a CPA to sit on the finance committee, and you show up as a guest, you're providing advice, you just don't get to vote. So if that's your organization, think about that. Okay, there we go. I made it to the end, and I have a little bit of time left.
Okay, y'all, it's time for questions. And I'm going to run around with this mic so that those who are listening online can hear them. All right, you're first.
Hi there. Thanks so much. Great presentation. My name is Wes Keys. I'm from Dallas, Texas, with a group called Brother Bill's Helping Hand. My question, we run a food pantry. We have a clinic. So I get so much in-kind donations. And we track those quite a bit, and they help us, especially when we're talking about G&A and fundraising and those dollars. They offset that a lot. Can you talk a little bit how people should track their in-kind gifts?
Great question, and I don't have time to go into that really deep. That's actually become a very contentious issue in certain states, in particular the West Coast. But certainly, if you want to monitor those, you would record those in kind, and there is a specific way to value that now. So you would want to follow that guidance. You can search it online. Or, by the way, I've got my business card. If anybody wants to stay in contact or ask more specific questions, I'm happy to answer those. I'll just let you scan my QR code, and we can stay in contact. But certainly, I can get you some guidance. We actually have an office in Dallas. I can get you in contact with our audit partner there, Junis, who is an expert in this area as well, so you're fortunate. But yeah, at the end of the day, to keep it high level and simple, you absolutely want to record that income. Let me restate that. If you decide you want to report the income, you want to make sure you're also offsetting it with the equal expense value so it's a net zero. Because of the complexities in certain states, some organizations, especially if you're dealing with pharmaceuticals or regulated products, if you will, have chosen to no longer track that, and it becomes a policy change in their financial statements. So that's why I don't want to go too deep, because there is legal and accounting risk now that I want to make sure you're aware of in tracking it. But at a minimum, if you choose to track it, and if it's if you have like a closed closet or a food pantry, that's not as heavily regulated as pharmaceuticals. But certainly you would record it at the appropriate market value that is prescribed, and then you would then also expense it at the same point. Great question.
Oh, I think you had your hand. I think you had your hand up the earliest.
Hi, I'm Andrea from Epic Homeschool Network. Can you do the restricted funds? Can you file a 990 EZ if you have restricted funds?
Yes.
Yes, there's a live debate amongst our board going years back, and the question is around those short months during the summertime. What are your thoughts on using short-term credit for operating expenses that gets paid off in a short couple of months?
Great question, and I will solve that debate for your board right now. Just kidding. I won't be able to solve the debate for you. Let me start by saying I think it's always a prudent, wise decision within the policies of your organization. Some have strong opinions one way or the other, but it sounds like you already do, that allow that. Having a line of credit is always a great strategy, okay? Having a line of credit when you don't need it is always a great strategy, because when you need it, nobody's going to give it to you, okay? Now, if you're going to be planning to use it every summer, at some point, you might want to create a strategy that says, how short are we? How much do we dip into it every year? Why don't we create that as a reserve, earn interest on it instead of paying interest? And that becomes a maturation of the organization towards more sophistication and a cash management policy, and an investment policy. So that's the longer answer, but it's not wrong. A lot of organizations do it for cash flow like that. But then what happens if you can't pay it back? And now you're triggering the dominoes that are hard to get back up. Great question. Yes?
Thank you. I'm Sandy Washington from Lifestyles of Maryland. And a couple of things. What do you think about, with our organization, we file, our budget is on an accrual rather than cash. And is there a benefit to that, or do you think about should we change that, or can that be changed? We've been in existence a long time, so trying to change that now and looking at the benefits of that. And then looking at diversifying income. A lot of grants and government money causes for reimbursement rather than outright dollars, and any recommendations for diversifying income.
So I'm not sure I can answer all those questions, but certainly I'll be around for a while. Let me start with the accrual versus cash accounting really quick. Cash accounting is just whatever's in, whatever goes out. And so let me use one simple illustration to say why. And I'll be honest with you, I have a bias. I'm a CPA. I'm an accountant. I like accrual. Why? Let's assume you've got insurance payments, annual policies, and it's $12,000 a year. And in the month that you pay that, do you want that expense for the year, or is that a benefit all year? I would rather record that as an accrual. It's a prepaid, and every year I expense $1,000 because that's the value of the insurance every month. Or I buy a brand new van for $100,000 to make deliveries. On a cash basis, that's an expense then. Versus, no, that van's going to last us X amount of years, and so now we're going to depreciate it over time, which is part of that whole accrual system. So it's far more sophisticated, and it's a lot more accurate. That's why we always, as you mature as an organization, become more complex, and if you have audited financial statements, you will be using the accrual basis. As far as diversifying, let me just quickly say, I'm a huge advocate for diversifying revenue streams within an organization so you're not dependent on one classification or one category. Even within a donor base, you want to have a solid foundation of what we call small donors, mid-level, large, mega donors if you can. Within the grant basis, you want to think about that impact. I will say my experience within grant writing and grant receiving, there's a lot more involved, so depending if you get an audit or not, I work with a lot of organizations that say, we want to apply for a $250,000 audit. We're a $150,000 a year organization, so that's going to be twice their budget or more. But it's going to cost them $20,000 for an audit to be able to get that grant. There's not enough unrestricted dollars to pay for that to get money that they can only use a certain way. So then that actually makes them go backwards, and they don't have the money to upfront the expense before they get reimbursed. So it doesn't always work that way, but there are other ways to find additional revenue streams.
Hi, my name is Sharon. I'm with Vox Teen Communications. We pay a lot of youth, and most recently we formalized our internship program, meaning that they're being paid through payroll. Is there a specific way I should differentiate between the programmatic internship experience, payroll, taxes, or does it all go into the same line item?
Great question. I don't know if there's a hard and fast rule for that, but I would certainly say if your interns are working within a program, then I would allocate those dollars, payroll dollars, if you will, to that program expense. If you have an intern working in the business office, that would be G&A. And then it would be specific if you have multiple programs, they would be those students per program. Yeah.
Hi, I'm Catherine with Reach for Excellence here in Atlanta. And I have a question about board governance. When you mentioned that having non-board members on a finance committee, that you can't have a voting non-board member, but that you could have a guest non-board member. Is there a place where I can go find that information? Where is it codified? Just because we are actually in the process right now of bringing on non-board members to some of our committees, the Finance Committee being one of them, and I want to make certain that we're following the appropriate guidelines.
Yeah, great question. To keep it real simple and make it generic for everybody, you can just Google Finance Committee statutes and then put the name of the state, and it will actually give you the codification by the state you're asking for.
And are there other committees that will have similar rules if we're adding non-board members to other committees? Are there other watch-out areas?
As far as statutes, I don't know. I do specialize more in the finance and audit side from a state statute. I will say certain states, for example, or at least by best practice, your nominating committee and your governance committee of the board should only be board members.
Okay.
That's just a best practice. You don't want a non-board member sitting on a governance committee. Right. Now, you can bring them in as a guest, as an advisor to help you set up the right things and provide advice. But as a regular standing committee, your governance committee and your nominating committee, I would always advocate as a best practice, should only be board members. Beyond that, I don't know, it would be state by state specific, depending on the size of the organization, what kind of funding you may be getting from certain government agencies will sometimes dictate that as well. Sometimes more from the funding agency than even from the Secretary of State of that state.
Thanks.
Yep, great questions.
So I don't want to ignore our online crowd. Anna, do you have any questions and one, maybe two questions that we could take from the online group? Okay.
I put them to sleep. They
All
weren't
right.
listening.
Let's go for one more in the time we have, and then you'll hang around, Stan,
I'll be up
after we
front here
finish.
for a while. Absolutely.
Okay. I'm just going to go here.
Thank you. My name's Seema. I'm with 48 and 48, which is here in Atlanta. My question specifically is when we were talking earlier about diversifying funds, yes, we have sponsors, but we're also trying to create some sustainable revenue for ourselves. Is there a marker that we need to be aware of where, okay, you're no longer a nonprofit or you need to file differently?
There are at the federal level, and it would be different at the state level. So one of the things you want to think about for the contributions, you want to make sure that there's what's the word I'm looking for? Sufficient variety of donors. If you have a limited number of donors that are funding more than 50% or more than 35% of the organization, then you're at risk of becoming a private foundation. And that changes the game altogether. So you want to make sure that, certainly in the startup period, obviously you're going to have some, maybe the board themselves are funding a lot of it to get started. But you want to, within that 5-year window, you want to make sure you've got enough donors that are funding the majority of the organization. You can actually get into sales that are product related as another revenue stream. So books, events, where you're charging, and that becomes a nice revenue stream, and that there is no limit on. But you want to be careful in getting into what we call unrelated business income, which then creates an unrelated business income tax. And those become challenges where suddenly you're doing things that are outside the scope of your incorporation and what you're authorized to do with the IRS. And then that can put you at risk. So there's several things you want to look at. And if you're doing an audit now, A, or B, certainly whoever's doing your 990 should be as a CPA, they should be providing that for you as part of the analytics every year. I know our firm does that for all of our clients. Here's where you're at. Here, are you getting close? Do we need to think about a strategy to help you, change something up because you're getting too close to one of those markers? And there are different markers federally. And then at the state level, some states have a different marker as well.